right. Hello, everyone. Welcome back to our NuView Wednesday at 1 workshop. We're really excited to host our first multifamily panel. We had a lot of great speakers over the last couple of weeks. We learned a lot about multifamily investing, especially using it in a self-directed IRA. So I'm real happy to bring back the speakers, and we're going to ask some tough questions about the market and how things are moving and about asset classes and if you have questions, there is a QR code. You can scan that QR code, submit additional questions as we're going through the Q&A. But we're going to go and introduce everyone one at a time again in case you forgot who they were. And if you want to reach out to them, we'll make sure we get you their contact information at the end as well. All right, so let's go ahead and get started. All right, Steven, you are first. Steven with Smartland. Go ahead and introduce yourself.
Hey, good afternoon. Steven Gesis with Smartland here. Thank you. We're owner-operators of multifamily throughout Ohio and South Florida. Our background was in heavy value-add multifamily. We offer direct investments as well as blind pool investments, and we work with a lot of self-directed IRA accredited investors to help them build wealth, both here domestically, and we've helped many afar internationally as well. So thank you so much.
Awesome. Thank you so much, Steven. All right, next up is Corneilous Cannon. Cornelius, how are you?
Outstanding. Hello, everyone. My name is Corneilous Cannon. I'm actually the managing partner of the Sharp Pool Capital. We're an online platform that allow people to invest in multifamily at a better opportunity and also at an easier threshold to get in there, and also allow you to evaluate deals from the experts as well. So we own that platform right now. So I'm glad to be here to get some value and help and connect with more people as well.
All right, awesome. Thanks, Cornelius. Next up is Chris Salerno with QC Capital. Chris?
Yes, thanks so much for having me. Chris Salerno here. We're based out of Charlotte, North Carolina, is where our headquarters. We are owner-operators throughout the Southeast, acquiring newer assets anywhere from 2,000 to present, larger assets that are 100 to 350 units. And we do that with individuals like yourself who are accredited investors, maybe looking to diversify their 401k or IRA into investing into deals like ours. And our span goes from United States all the way across the world. We have clients in Singapore, Shanghai, and Europe as well. So love to be here. Can't wait to add value and give you guys some of my knowledge on where the current market is.
Awesome. Thank you so much, Chris. And last but not least, Satch Bernhardt with Bernhardt Capital.
Hey, Brian. Thank you for having me. And Satch here, owner of Bernhardt Capital. We are a private equity firm. We focus on value-add multifamily properties, Class A and B, in Arizona, Texas, and Florida. We partner with great operators with great track records, 100 units plus. And I'm looking forward to answering many questions. Many of the people that invest with us are busy professionals, and a lot of them are pilots as well. I used to be an airline pilot, so we work with a lot of pilots. So looking forward to this, looking forward to answering questions and getting some information out there.
Awesome. Thank you so much, guys. All right. So now we're going to dive into some questions that are on everybody's minds. With the interest rates rising the way they are right now, how is that affecting the multifamily market? And we can start with Chris.
Yeah, that's a great question. I hear that a lot. I get asked that a lot through our investing database. And, I think it's going to impact the market in a positive way, in my opinion. When interest rates increase, they mainly are affecting the single family housing market. When it comes to us, when we underwrite, we really go off the 10-year treasury and where that's being fluctuated when it comes to our type of debt with our commercial assets. When it comes to regular, for example, the Feds are meeting today, they're going to raise interest rates probably 0.50. When they raise that, that's going to be raising the single family market, which is going to price individuals out. The lovely part about investing in a multifamily, and I came from the single family space. I was in it 8.5 years ago, created QC in 2019, and got into the multifamily space is because shelter is a necessity. We need it. So when the single family housing space gets really a hard pressure on it from the rise of interest rates, and people are getting priced out because the home values is way too much for them to afford, they're going to go rent. They're going to go find an apartment complex to rent. And at the end of the day, it comes down to the basics of supply and demand. We have very little supply of multifamily, and there's a large amount of demand. And every time they raise interest rates, the demand is going to increase because people are going to get priced out of the single family housing market, and builders are putting everything on hold right now due to labor costs, due to inflation, and due to the current market environment when it comes to the interest rates. And so people need a place to live. It's a necessity. So I'm seeing them come to the come to the multifamily, our assets that we currently have. So we're running at a little higher occupancy, and we're still increasing rents, which our investors are benefiting from that.
I
Yeah, anyone want to
love
add to
everything
that?
that Chris said. Oh, sorry, I didn't mean to interject, but it's so refreshing to hear that because we came out of the similar single family space, did the thousand scattered site thing, sold that business in 15, went to scale with the apartments from this necessity that Chris was saying, and then the question arose from, hey, how do you feel about these interest rates? Well, Chris hit it right on the nail. I mean, in reality, the immediate affected market is definitely that single space. It's pricing people out. It's forcing more renters. It's forcing, and that gets what Chris is saying also is a great point because essentially what's happening in this condition is that you also have market rates that are rents that are unabated, right? So like, there's really nothing stopping them because there's this deflection in building, or there's this association with logistics that's making it compromising the building. And so actually, what to even further Chris's point, and I love that Chris stepped right in on that because this is exactly what the market's about. When you're in multifamily, we're pricing against treasuries, and in reality, what Chris does, what we do on this call, what's fascinating is that in a value add perspective, if you're value buying, right, and if let's say we are facing some pressures in interest rates, look, we're talking about still buying at a good basis. We're still building the value through forced appreciation. We're not doing anything unique here, right? So we're producing that. We're getting unabated market rate rent still in the face of all these headwinds with rising interest rates. However, it's just still not there yet, which is causing more people to come rent. And then we're seeing builders walking into BFR, build for rent, right? So for rent space is exponentially growing. So I mean, Chris' point, he began what'd you say, Chris, 8 or 10 years ago? And so 8 or 10 years ago, also being from that world, when it was rock bottom and people didn't know, and then all of a sudden it became really peachy fuzzy. But in reality, we all knew the storm was coming. It was temporary that we were sitting at zero, and so I think I think operators that have been in this space and have some historical background behind them are pricing in some of this, challenge. However, at the end of the day, it still sticks to the same, ABCs. Stick to your discipline, stick to your underwriting. Don't let it falter, even in these headwind conditions, whether it's market competition or low interest rates drives even more competition. So higher interest rates, things are a little bit there's a little bit less product that's seasonal right now. There's some adjustments. There's some things that people have to get used to in the market. There's some adjustments in the credit markets due to this. However, to Chris's point, the predominant factor that's being affected is that single family space. And with that said, you're only getting this high rise in multifamily demand from it. So I just wanted to chime in on that, and as I said, just support what Chris was saying. It's so right on.
I think one of the highlights you said is that when you get to high demand, you're getting a higher pricing. So one of the things that people don't realize that you can refinance a loan, but you cannot refinance a bad price. So what we're trying to do is we're trying to acquire at different rates. Like we're going into converting hotels into a multifamily. We're going to you see office space getting converted. So what we're doing, we find cheaper products and converting them into a high demand market. Is one of the
Well,
things
you're
that how we
forcing
supposed to manage well.
appreciation. You're forcing a product, right? So same thing like what Chris or what we do, same thing, right? With the value add, you're forcing some sort of appreciation, and that's how you build the value. So great, Cornelius. That was great to hear also because that's what this market demands, right? So it's a shift in your mindset, right? Like you need a heavy value add operator. You need somebody that's going to do something transformational in this marketplace because this is that bridge time, right? Where things are maybe a little bit more expensive at the door with the interest rates. However, if you could offset it over the next three, you could refi it out, at a softer time when interest rates should, hopefully we'll see some sort of regression on that. And I'm sure we will, historical model show. And I just did a webinar last week when we were, talking about from a purely like from a timing, like speed perspective, like this is the fastest that we've ever seen interest rates go up, right? Historically, it doesn't matter whether you're looking at the 80s, the 90s, the 70s, whatever market conditions you're looking at. From a pure velocity standpoint, you went from 0 to 6 overnight, right? That's not the
Mm-hmm.
set rate, but you understand what I'm saying. So from a pure speed, and then we'll see what happens today. I haven't seen the news yet, so I'm waiting to get that ping. Yeah,
Yeah.
Get that ping. I like that. Get that
I
ping.
can tell you, to everybody's point, first-hand experience, out of all my investments, I have multifamily and I have one single family home on the market. Out of all of them, the only thing I'm worried about is that one single family home that is on the market right now. I'm not getting offers. Is the nicest home in the area, and it's just not moving. All of the multifamily stuff that I have, I'm not even worried about it.
of
All
course,
right.
yes, because you can control that moment, right? You're not subject to your neighbor in this case with multifamily as
Yep.
you are with single family.
Yeah, I agree. Right now, a lot of people that maybe just graduated college or were looking to be a first-time home buyer, well, now they're sitting on the sidelines because they're not qualifying with these high interest rates. So they're being forced to be renters even longer, which is actually working to the benefit of multifamily, in my opinion. I was at a conference last week, and I learned a lot about what they're hearing in the market as well. Has your underwriting changed since the market's been fluctuating the way it is? We could start with Steven with that one.
So, from an underwriting perspective, what we have to do is just balance. Um, so, so let me start again. So, underwriting did change because credit market shifted. So, if earlier in 2022 we were looking at 80/20 bridge loan products, 80 LTC bridge loan products to do the heavy value add, right? So that's getting a loan with a construction component already integrated in it. Now that's shifted, right? Interest rates are slightly higher, and also it's much more challenging to get 80/20 conditions. You're getting 75/25. In some cases, you have to have some predictability if you need a rate cap, depending on the type of loan product. So the thing that did really change from an underwriting perspective is really more of the debt side. From an equity side, not so much because we're still hunting for the same profile return. So for us, right, it's like managing the expectations now of sellers rather than us just being buyers. And so I think there's going to be a stagnation or an adjustment there, but that adjustment has, I think, now becoming coming to market. And so what I mean by that is that sellers that began their thought process in January went to market in May, June. Now they hit some inflection points with these interest rates. They may have pulled back. Now they're easing the thought that, hey, look, I got to maybe if I do need a trade, I got to trade this thing for less than I expected. And so that's kind of coming to fruition, but very slowly. And so there's also the same thing, stagnation, because not everybody has to be a seller. Like to Chris's point earlier, Satch, or Corneilous, what you guys said is that rents have been unabated the last few years, right? So not everybody has to be a seller. And so that's kind of where we're seeing in an underwriting perspective. So we are being very, very cautious, but cautious in the respect of steady Eddie business for us. Just cautious as what we're looking at and what the basis is today.
So I think so underwriting has changed because of our desire of how we acquire properties, and our plan to exit properties have changed as well. So all that kind of accounts for how we underwrite our properties. And I think that one of the things that you all talked about highly was that how essentially baby boomers are college graduates are not buying houses or first time buyers anymore. I think that is one piece of it, but also if you look at historically, we on a 30-year kind of downflow of home sales. So I think that the trend of human behavior is not buying homes no more as much as we used to. I mean, we're on a 30-year trend. It's not a trend anymore. It's like almost like it's going that way direction, and that's just before even the pandemic. We was actually on that downward slope. So I think that is only going to accelerate the multifamily market altogether, or the rental market altogether, because of the ability of people to be able to qualify for a home, but also the desire to buy a home is decreasing.
Yep. And I would say to Steven's point, like much of the underwriting fundamentals are not changing as far as right. We're still doing the same. Maybe not being we're decreasing the increased rate of appreciation on the rent over the years. Before us, we will do 3 to 5% increase in rent. Now we're just doing 2%, right? So some of those things were kind of slowing down. and but we're still projecting the exit cap rate to be higher than what the market is at the time of purchase, and those fundamentals still stay there, but the debt is what really changes, right? Because given that the interest rate went up, we can't be doing what we were doing before, right? With the bridge loans and stuff like that. So we really got get creative on that side, and with the capital stack, right? How much are we gonna borrow? How much, if we borrow this much money at 7.5%, then we can go all the way to 75 with that, right? We gotta maybe cap it at 50% and then use pref equity for another percentage of that, and just figure out a way to like adjust that capital stack to still hit the profile return that we have for our investors. That's the main thing that changes on the underwriting.
How about yourself, Chris?
Yeah, we've definitely changed the underwriting. I mean, it's very difficult to pencil in deals with where some of these sellers are at. We're seeing, normally December is a little slow time in our industry as, sellers are waiting to gear up for the new year to sell. I think, when it comes to underwriting, we are still a little ways off from where sellers are currently at, but we're staying very strong. I mean, we're getting brokers and sellers coming back to us saying, "Hey, does your offer still stand? Can we still do a deal?" And we're like, not really. It doesn't stand because of we underwrote differently 2 months ago to the current market environment. So, we're watching that very closely. We're also watching the rent growth very closely when we underwrite rent growth. And we're currently raising for a deal right now in Houston for deer at Herman Park, a beautiful asset in the medical center. And we're hearing certain things from those investors that have invested with other assets. And so we like jotting that down. So when we're looking for future opportunities, we're hearing, what investors are looking for on a daily basis when it comes to it. So yeah, it's changed with the current debt environment. I think it may be advantageous to go ahead and do a bridge loan possibly. And some of you out there, if you think bridge, you're like, why would I say that? Well, we're raising interest rates so much, just like someone said on this call, that we haven't seen that no one's seen that in the past 8 months, how we increased interest rates substantially. And there's going to be a point in time, I believe in 2 to 5 years, that they're going to have to drop those interest rates. I think they can't just keep them up at 10%, 9% where they're at the moment. They're going to have to drop them back down, and they're going to have to do that very closely. Keep in mind, in 2 years, we have another presidential election, which there's a certain party that wants in still. And so they're going to have to make sure that, the economy is strong going into that election, or they may lose their seats. So,
yeah, 100%. So following that, what type of exit strategies are you having to protect your investors right now? We can start with Cornelius with that one.
We're looking at a couple of things, a different market. Like right now, we're heavily on doing conversions, on hotel conversions right now. So we're actually excited to see how we actually buy at a lower rate and actually we're entering a high demand market. So we're looking at because we evaluate ideas a little different because of we're going from one asset class to a different asset class. But we have we turn our residents to like long-term tenants than actually apartment owners, apartment residents. So we're looking at exiting to the market where people are actually getting in the multifamily market. So we're kind of we're seeing we kind of seem very excited to be able to do that because a lot of people hop into multifamily, but we're actually entering that market because we're going from a hotel conversion to that market there.
Okay. How about you, Satch? How are you protecting your investors right now?
As far as the protection, I would say multiple X's will be the right answer, right? Certain the right expectations. I think Steven talked about that earlier. Right now, I think a lot of investors have seen these drastic exits, 18 months, 17 months, 23 months, right? And delivering above projected return to investors and setting up the right expectation. Like, hey, that's probably not going to continue to happen in the next few years, right? So set the right expectation to be in the deal for 5 to 7 years. And one of the X's is to be able to refinance I think most operators, at least the ones I work with, we hope to refinance out of the property in 2 to 3 years. But if that were to not be an option because of interest rates, let's say they were still high for some reason, then can we still make the deal work if we were to not refinance and continue on for another 2 years, right? If that's still a yes, then obviously that's good for everybody, right? So in that sense, it's still setting out the right expectation. Like, hey, there's a chance. Um, our priority is to capital preservation, right? So if we can, if you don't, just make sure that you don't need the money. Obviously, don't be hoping to get the money in 2 years, because that might not be an option, right? And as long as all of those boxes are checked, we feel pretty confident on our priority, which is capital preservation, and then being able to exit later down the road.
Steven, have you changed what exit strategy? Are you using similar tactics?
So no, for us, it's for us, it's a really simple equation. Number one, if there's an asset coming due, first priority is to just effectively check, hey, look, what's the most advantageous exit option, right? Is it through a sale? And if we can achieve that number through a sale, and if we can get an equal number through a refinance, we're going to refinance. And the simple truth of it is that even in this type of, kind of tougher market, right, that everybody keeps, kind of pushing on, using these select words, right? Look, at the end of the day, for example, our limited partners come in for a pretty hefty return, right? We're talking about, and I'm sure genuinely everybody on this call can attest to this. We're talking about high teens, low 20s, right, in returns. So even in a tough marketplace, let's say even in a tougher debt marketplace, a lot of us operators that are doing the heavy value add or the transformational stuff where we've been able to build that value, we could preserve an exit in any condition, because even though it's, let's say, more expensive debt today, it's still
Mm-hmm.
less expensive than the limited partnership money. So there are options, and the option for the most preferential exit exists whether it's in a really low interest rate environment or a slightly higher interest rate environment. So I think from a protectionary component, the exit structure is going to remain the same and it's going to stay status quo. And the ultimate driver is going to be which option, right? Which fork option are you going to select that's going to just ultimately drive the maximum price point? And then, as Satch said, it's setting the right expectations in the forefront, right? So, like, in some cases, all of our deals are set up for 5, and in some cases, 5 to 7, right? So we have a fund that operates 5 to 7 because we need that ability to pivot, right? So we set those expectations in the forefront. We let investors know that, hey, look, ultimately our goal is to buy you out. Your money is expensive, and this is the fact, right? Like, we don't need to hide from it. This money is expensive. We appreciate our accredited investors that participate with us. They earned it, and they earn that return, and they earn this profile of return because they're participating in alternatives. But at the end of the day, we do have a vested interest, both from fiduciary to exit at the highest possible value to the investors, but equally protecting the position from any type of market condition. And so, I love this question because the option always exists. And so, as long as you're an operator and you're in it to do the right thing and investor centric, I think you're going to find the right protectionary components and effortlessly, whether it's in a low interest rate market or a higher interest rate market. All we're doing is we're again just adjusting, right? So like today, it's not as pretty of a profile, but in 3 months from now, once we get an adjustment to new market conditions with the appropriate cap rates, with these new interest rates, look, we're going to be back to regular business. At the end of the day, sophisticated money also has to place money in stabilized assets that we on this call are working on, right? So the money has to continue to pivot further on, and so through stabilization, through this forced impact value building, right? We're taking it to this next level. And the next thing about that is that I think right before this convo, Chris mentioned something working with like a Freddie, right? So once we're at stable, keep in mind the exit at stable on a stable asset, your funding sources and the funding cost at this point is also different, right? Those credit markets are different from when you're beginning stages of doing that first value add component. So there are these other inherent things that we have to consider as we maneuver through this life cycle or ecosystem or stages of this process of this investment type. And so that's actually what makes me really excited about this investment type, is that it allows for this level, right, of like levers and maneuvering and also like idea building and creativity, which is so different from single family or other types of businesses. And so this alternative space is so unique to that point where, yes, we could talk about current or existing or pre-existing market conditions, and we can, tune to that.
All right. Chris, did you want to add anything to that? How has QC Capital changed their exit strategies?
Yeah, no, I mean, very similar, spot on there. I mean, we are looking for refinance structure, but it's mainly longer term holds, anywhere from that 3 to 7 years. And we all let investing partners know who invest with us, or alongside of us, that expect it could be longer, it could be shorter. You never know, especially with these type of assets. We do it. I do personally invest alongside all of our investing partners in each deal. So I'm also seeing it from that LP perspective, but we are having a little longer term holds, and then we're really watching the exit price on where are we going to exit. We, at the end of the day, no one can predict what the Feds are going to do in a year from now, or 2 years from now. But if you're buying great quality assets in great locations that are cash flowing with great quality tenants, I think you're going to, weather out the storm and be very strong. The deal we have in Houston, median household income for that deal itself is $100,000. Our tenants make $100,000 as a median income for the whole property. So those are great quality tenants, and it's collected by the first of every month. So those are assets that we like, where we're not chasing down tenants, trying to get them to pay, or tenants know more about the laws than we do, and they know how to finagle everything so they don't pay. We've seen that during COVID. I think a lot of operators seen that during COVID, and that's why a lot left the older type of assets. So yeah, we're really making sure we're buying good quality assets in great locations that with tenants that are paying rent.
Yeah, it's a crazy market out there right now. Would you say it's a buyer or seller's market right now?
I would say right now we're still in that neutral area, in my opinion, coming from the brokerage side, seeing, both buyer and sellers. I think we're in a neutral period. I told the team at the very beginning of the year, with everything that's going on, we left Bridge, we went to Fix. And I told them, I said, the last individuals to realize their property value has decreased are sellers. And so what's going to happen is the brokers are going to try to get all the buyers up as much as possible. But the buyers are going to say, look, we're capped out at X price, capped out at X price. And then they're going to have to present those offers to the sellers. Then the sellers look, and the sellers get mad at the brokers that they didn't get them a good enough offer. And then so the what happens is the seller takes the property off the market and they just hold it. And so we've seen that. And then with these individuals that have funds, they have to liquidate. Or individuals who have bridge loans and they did not buy a cap, or they maybe bought a cap and their cap has come due, where they're going to either have to raise that additional capital to pay out their investors, or do capital calls to bring more capital in, which is going to go ahead and dilute the current investors' percentages of ownership to weather out the storm. I think, at the moment, it's that neutral stage still. Sellers don't want to take 15 to 20% decreases in their properties unless they are forced to sell. Unless it's, I'm going to foreclose, or I'm going to have to, pay our investors nothing, or I need to sell now and pay them something. I think that's what is going to be happening in the next Q1, Q2 of next year. But right now, I think it's still in that neutral stage where sellers are still not realizing where the current market is, and some are when they're forced to sell.
Yeah, that makes sense. Okay, so I've got a ton of questions here, so I'm going to read this one word for word here. It's a long one. With values most likely to drop, how will managing partners or GPs and managing members cover required covenant gaps in loan terms as the lenders realize the borrowed funds and the expected or ongoing NOI may not be in line with the original terms?
I think that type of question is more in line with like a core plus product, right? So from a value add perspective, right, you're going into it subject to increasing that position. And so, you're going in there typically below market rate rents, and you're looking to just at least increase the market rate or get a little bit above. And one of the guys mentioned, I think it was Sash, he mentioned that you're looking at underwriting now models that you're doing maybe a 2-point appreciation annualized rather than like a 5 to 7, how we looked at it earlier in the year. And so I think that's a very good question. And so with that being said, actually, there's already specialty lenders in place in the market that are coming in and scooping up these types of conditional issues. And so actually, you're seeing a lot of these conditional issues, at least the reports that I'm reading in various Financial Times and financial market datas, is that really you're seeing it in like the new construction elements, right? So they underwrote it for a certain price. They went into it. They got far along. They ran out of money along the way due to logistics problems, price going up. So they're pretty far along in their construction, or they've completed construction and now they have to, they have to refi out, and so they have some conditional issues there, or they have debt service coverage ratios where they're not hitting their pro formas as expected because they have a higher saturation of units around them than expected that hit the market. So there are a lot of various, I think, situations like that are occurring. I think it's more in those existing Class A, Class B markets. I don't think it's as much in that Class C, B, where you're doing the heavy multi-value add. At least I don't think you're seeing that fragmentation or cracking quite yet in that place, because again, you're talking about existing infrastructure that is likely occupied, that is performing, and was underwriting to a certain condition. And so, I read a report, there's like 1,400 multifamilies out there, or various commercial real estate notes that are already below the DSCR covenants. However, again, keep in mind, even with that being said, this is not such an easy statement to float, because not all banks are built the same. Not all banks are prepared to work on those covenants. Not all banks have the appropriate workout teams in place to be able to establish what that next move is. So that's still kind of in the works. And so hopefully, if things kind of materialize and stabilize, or things kind of get a little bit more rational over the next few weeks, which it will, and it has been progressively, since the uptick began. You'll see that some of these issues will go to the wayside, and there will be negotiations. At the end of the day, let's all be real, right? Let's keep it really simple. Banks are not in the business of taking back assets and managing them, right? This is the last thing that they really want to do. So, from just purely, if you take this fundamental component, right, and you ask yourself, those conditions where they are taking it back, they're like in deep water, right? They're in a condition where, and a lot of times, operators in those conditions, they're voluntarily giving it up. So that, and that even happens during good times. So, I know there's a roundabout way of coming to this answer, but I really think that the condition that you prescribe is specific to maybe a certain, way that an asset is getting to market today, or where it began its life cycle and where it is today.
I think Steven's made a good point. It's like the banks they're not in the market of trying to take things back. I think what happened is it goes out to foundation. Like communication is key. I think a lot of times, like even during COVID, a lot of people just froze up and not say anything at all. Like if you're in trouble, communicate with your investors, communicate with your lenders. If everybody just communicate properly, they understand like there's things that happen that you can't control, right? So you focus on the things that you can control, and that's what things go. But a lot of times people stop communicating, or they try to do bad communication. Then you start assuming, and the worst started happening. So a lot of things can be mitigated if we just communicate properly. And I think that's what a lot of people fail to understand. Like they take it as a self thing of exposing themselves, but that transparency actually build more trust.
Mm-hmm.
Yeah, you're spot on there. I want to second that. We have a deal that we closed at the beginning of the year, and we actually, after closing, we caught something that the seller did not disclose, and even our lender did not disclose it. And we voluntarily emailed and then let our lender know, hey, just to let you know, we caught this. And it did fluctuate anything. Obviously, they couldn't do anything. No one could do anything. But we caught it after the fact that we closed, and even our lender didn't catch it, but we made our lender aware of it. And it's just being that transparent, also being transparent with our investing partners, letting them know what's going on. Through the deal, I think you will build a stronger and a better foundation of a business if you're just being transparent, not only with the bank, because they are your biggest investor, and also your investing partners who are writing $50,000 checks that are, putting their hard-earned money into these type of assets in these deals to operate.
All right. Yeah. I have another question here. Why should someone with a self-directed IRA consider investing in multifamily?
That is actually a really easy question. Can I head that one? Can I head it?
I'll second you after.
So number one, it's a hard asset. Listen to Ray Dalio recent. I'm not preaching anybody's book here, but he's a pretty smart guy. I'm not saying he's the right guy. All I'm saying is that, look, at the end of the day, holding cash even in today's market is just a poor idea. Yes, maybe things are coming. You could bridge it over. You can get the cash back after you do a nice investment in a real asset. Even if it's not a real asset like multifamily, pick another real asset. Go buy a private jet. Whatever it is, just don't keep it in cash. And here's the simple end of it, okay? The simple end of it is really simple. Right now, at a 7% inflation, if you think you have $1 million in buying power, by the end of the year, if you didn't deploy that $1 million, it lost 7%. That's how much less buying power you have today. Even if we said in our multifamily deals that we pay 0% to you at the end of the deal, and you put your hard-earned money, your self-directed money, into a deal today, into a hard asset today, even if we paid you 0, you're in a better cash position in 5 years than you were today, simply from deploying an appreciation against and playing against this inflationary market. At the bottom point of this that I'm trying to make is that anything into a real asset today is much stronger than holding it in a cash position, simply against inflation. Something that produces cash flow like multifamily and is a real asset, that's the bee's knees of investing, right? It's the most tangible, easiest, approachable, accessible. You're on a call today, right, with guys that are boots on the ground, direct access. This is not a webinar about, working through a platform and not knowing who you're working with, right? You're working directly with an owner, operator, sponsor. And so you can have that intimate relationship that you want with that, number one, so that way you can have that, ultimate connection to those dollars. And number two, keeping it as cash is just not the right condition, especially in a highly inflationary condition.
Spot on there, Steven. I love that. I want to second that. When it comes to investing in the current market, it's very volatile. At the end of the day, you don't know what's going on, and you're not going to know what's going on in 2023, in my opinion. When it comes to a fixed asset, like I said earlier, it's a necessity. We all need shelter. First, we'll look for food, and then we need shelter. That's just how it works. I mean, they did that back in the Stone Age with the caveman. They went to go look for food, then they went to go look for a cave. So we all need shelter. It's a necessity. There's a supply and demand shortage when it comes to it, housing. And so why wouldn't you want to be in a opportunity that there's a supply and demand shortage? We're not going to be able to get caught up till 2023, and that's just to be caught up. Historically, every 10 years, they've been a market correction or market cycle, recession. When that happens, that just puts us back even more. Also, when it comes to a market or investing in the markets, there's a lovely thing called social media these days. You'll have certain CEOs decide to tweet something, just, I don't know what they were thinking, but they do. And their stock decides to go down 12%. I can assure you, with investing with us, I'm not going to tweet
something. It's like Chris
something.
lives in my brain partially.
I know. I'm not going to tweet something and the property value is going to drop 12%. Yeah. Now, we understand the current market cycle. Property value may be down 12%. However, it's a necessity. People need shelter. And this is a cash flowing asset that's going to weather this storm that we're about to see. And it's going to come out very, very strong, because once those interest rates starts declining, the 10-year treasury starts declining, the valuation of our property is going to increase, because everyone in the single family space has already been priced out. We're charging more in rent. So or the debt's going to go down. It's going to be cheaper to lend. Everyone's going to start back on their buying spree, but rates are going to be high for rent, and we're going to be able to charge more for evaluation on our properties. So I think now's the best time to place capital, in my opinion, I'm doing it personally, into multifamily assets that cash flow very well, because once everything starts to tick out of this, the debt is going to be very cheap. It's going to be cheap to lend money. Once buyers are out there lending money, all the individuals who are renting are going to be paying premium because they couldn't afford a single family house, and we're running at high occupancy. That's going to be the best time to sell, and we're going to cash away, 1031 that capital into another deal and defer our taxes.
I think I love that. I think a lot of times we can look at the facts all day and tell why the reason why we should make sense. But I think a lot of times people don't highlight the emotional side of it. Like we all doing this for our own particular why we investing, why we working, why we doing that. I think that we understand like what are you trying to accomplish at the end of the day and so forth. Because a lot of times people be afraid to invest because they be afraid to make the wrong decision, not to make the right decision, but making the wrong decision. So what happens is they make the decision at all. And I think that one of the things that we have to do is really get educated and really kind of figure out, hey, this it makes a lot of sense, but also emotionally it fits with my core values, the one I'm trying to accomplish in life. And you're saying multifamily, this is not something new that came this year. We're not the pioneers of it. People have done it way before us. Way before we were born. And just that the opportunity to invest in multifamily just been opened up a couple of years ago. But it's just like imagine. I say that a lot of times those people think about investing altogether. I really kind of get that core thing about what are you trying to do? Are you trying to avoid pain or the gain of pleasure? And really kind of dig down deep to our core. Why are we doing this in general?
Mm-hmm.
Yeah. Yeah.
Go ahead.
I was just going to say, I love what everybody said. I don't have anything else.
Just like ditto, just ditto.
I mean,
everybody.
My biggest thing is, the stock market is so unpredictable. You can't control it. It's not tangible. Like you said, somebody could tweet something, stocks can drop, and you can lose a ton of money. From experience working where I work, my phones were blowing up with people in tears that I spoke with a year ago, and they're like, I should have moved my money to NuView sooner. Now I lost, $60,000, and I'm trying to wait out the market, and hopefully it bounces back, and I make money back. But that's going to be a long game. It took them, 30 years accumulating this wealth, and then they can lose it in one day. Like it's outrageous how the market works. And, real estate's not going anywhere. It's always going to be there. It's brick, mortar, tangible. You can touch it. You can feel it. And, a lot of times these multifamily apartments, they're to capacity. I know I have friends that are renters still, and like, I can't find a place to live. I have to go outside of the city because it's just everything's full and there's just nothing available. So, I mean, that's just from my own experience, living in Orlando, Florida, which a lot of people are relocating to Florida right now. It's insane right now. I think Orlando is rated like top 20 places to live in the United States. So that's probably why I can feel it more
No,
than
it was in the top 10. It was in the top 10, yeah. And in fact,
Yeah.
like 5 cities in Florida were in the top 10. I was just in Orlando 2 weeks ago with the family. Great time.
Yeah. This next question is, I guess, more directed towards myself. It's how does UBIT or UDFI affect a Roth IRA when investing in a syndication? So when UBIT or UDFI is triggered, you are paying taxes, whether it's in a Roth or not, but you're paying taxes on the leveraged portion of your profit because you are making profit off of borrowed money. So yes, you're still going to get a K1 at the end of the day, whether it's in a Roth or a traditional IRA, but you're still also your investment in the Roth portion of your profit is still going to grow for you tax exempt, and you'll take it out tax free when you're ready to retire. Traditional IRA is going to grow tax deferred, and then when you retire and you're ready to start taking those required minimum distributions, well, you're going to pay taxes based on whatever your tax bracket is at the time you take those distributions. So it doesn't really change anything. It just means you're paying some taxes based on the borrowed portion of the property. The best way to answer it. All right, guys. So we're going to wrap it up. If you want to just tell everyone, we'll go one at a time and tell everyone what's the best way to reach you. So that way our audience knows how to contact you if they're interested in learning more about your opportunities. We're going to start with Chris.
Yeah, thanks so much for having myself and the company QC Capital and listening to us in regards to the questions and our opinion on where the market's at. Best way to get a hold of us, or if you're looking to become an investing partner alongside of us and to get opportunities that we send out to our investing partners, is go to our website, qccapitalgroup.com. In the top right-hand corner, it says Become an Investing Partner. Click on that. Fill out your information, and one of our team members will be directly in touch with you one-on-one to see if we're a good fit and to understand your goals and what we can do to help you achieve them.
All right, awesome. Satch, you want to go next?
Yeah, absolutely. And for investors to reach out to me, I'm very active in social media, so I'm constantly putting content. If you simply type in my name, you can follow me on any preferred social media platform. And I'm very active there, so we can engage in a conversation as well if you reach out to me through there. But I have a website as well. If you want to go to a website, it's bernhardtcapital.net. And you can schedule a time to get on a phone call with me or someone in my team, and we can see if we're a good fit and answer any questions that you may have.
Awesome. Thank you. Steven, go for it.
All right. Yes, thanks. So you can visit us at smartland.com. That's SMARTLAND.com. smartland.com, or you can call me on my personal cell phone, 305-209-6428. Email me at steven.g, that's with a V, steven.g@smartland.com, and text me, email me, call me, or one of my team members. We're available. Again, that's smartland.com, smartland.com. And
Awesome. Thank you so much, Steven. And Cornelius.
Outstanding. Well, yes, you can find me at multifamilydealroom.com. And there we got our free downloads. You can get the 5 steps of multifamily investing. And also come on our shows and see how real people do real deals on a real time basis. So that's what we got going on this year.
Awesome. All right, we're going to wrap it up. Thank you guys so much for joining us. This was a great panel. A lot of great information on the state of the market and multifamily and why people should be considering this asset class. Remember, NuView, we are a passive, self-directed IRA custodian. We do not advise you to make any investments. It's up to you as a self-directed IRA client to do your own due diligence before you make any investments. So whether you need to seek legal advice, talk to a CPA, financial advisor, you have to do that. And what we can do is custody that investment in a self-directed IRA, a solo 401k, a health savings account, into these types of alternative assets. It's a great way to diversify your portfolio and protect yourself so that you can retire happy and wealthy and leave that generational wealth to your future generations, kids and grandkids. So we're going to wrap it up. We'll catch you guys next Wednesday at 1 p.m. Not next Wednesday. Sorry. We're taking the next 2 weeks off, but we will be returning in January, and we're going to do a real estate series. So we'll be talking about things like fix and flips and Airbnb, short-term rentals, offshore real estate. So we got a lot of great topics coming up. So stay tuned. We'll be announcing those pretty short.